Hey, a couple of quick admin notes. First, welcome to our Trader User Group monthly recap for January 2015. Our monthly recaps are going to go the first Saturday of the new month for the prior month. So we're going to be running these things every month, 1 weekend a month, the first Saturday of the new month. That'll take, it'll replace our Sunday night session for our members. So for those of you that are members of our user group, this will be the this will replace the Sunday night session. Okay. Also, for all of our members out there today, this coming Thursday we have our option trade adjustment and position management education webinar series. It'll be kicking off. It's going to be really good. I think you guys are going to enjoy it. If you miss it, don't worry. It's going to be recorded and put into our library, so you'll be able to go in there and grab that. So no worries there. So that's a little bit about where we're sitting right now. So why don't we just jump into everything? By the way, this session will also be recorded and put in our blog as well. Some of you may be watching this session on YouTube or on other means, but you can just always click through and come to our website. Make sure you get registered on our blog so that you can receive our weekly market roundup that comes out on Saturday or Sunday. This will also replace the weekly market roundup when we do these monthly recaps. Now that you guys are totally confused, let's jump into everything. Trading securities can involve high risk and loss of any potential funds invested. Any investment information provided by our user group may not be appropriate for all investors, provided without respect to individual investor financial sophistication, situation, time horizon, or risk tolerance. Therefore, any information technique presented by our user groups tended to be for educational purposes only. It's not intended to be a recommendation to buy or sell any specific security, no matter what your rat brain's going to want you to do. Okay. Let's take a look at what's coming up this week, and then we'll just kind of take a step back and look at where we've been this year and where I think the markets are going to be heading. This is an international government economic data coming out this week. It includes the U.S. and Europe and a few other countries as well, as you can see. Monday, we got China coming out. Monday night, actually. Monday will be a quiet day, generally, internationally. No big reports hitting the wires. Monday night we got CPI data, which is really another word for inflation, measuring inflation. And we got the CPI and the PPI. The PPI, the producer price index, that's the cost of goods that companies pay to buy before they put it on the market and sell to consumers. The consumer price index, the CPI, is what we pay when we go to the store and we buy the stuff. So there's different costs. There's input costs and output costs, and it's a good measure of inflation. Right now, as you guys probably know, inflation is on a downward spiral, and countries all over the globe are trying to really jack up the stimulus. We've been talking about it for quite some time now, and they just did that in Europe with the ECB. So that's coming out on Monday. And then Wednesday, we've got the inflation report out of Great Britain and employment data out of Australia. But a big number, Great Britain inflation report. Now, you guys, especially members in our chat room, you know that we decided we took a couple of small trades in the British pound. I think a number of you guys made some money on it, or at least the ones that followed me on the trade did. It was just a quick trade. But the British pound is going to be a favorite of ours probably over the next 6 months. And we'll take a look at the chart, and I'll show you why when we get to the chart. But that inflation report is going to be really key for the pound, because if we see hints of inflation, if we see hints that it's getting higher, then the pound is going to move up, okay? Why? Because when there's more inflation, government central bankers tend to want to raise interest rates to reduce inflation. In this case, there is no inflation to speak of, so they've got interest rates very low. But I do believe the U.S. will be the first to raise inflation. The U.S. will be the first to raise interest rates, followed by Great Britain second. We probably won't see the European Union or the ECB group of countries raise their interest rates for quite some time. So anyway, we've got that on Wednesday. Thursday, Again, the BOE, Bank of England's Governor Carney, he runs the BOE. That's like the U.S.'s Janet Yellen. So when he speaks, the markets move over in Great Britain, and the pound moves, and sometimes the currency moves a pretty good bit, even over here in the U.S., depending on what this guy is going to say. Retail sales numbers on Thursday as well. And then we got GDP quarter over quarter, Q4 for Europe, and that's going to be Friday. So we do have some, I believe this week, some stronger international reports, primarily over in Europe. We kick it off with the inflation data via CPI and PPI in China, but we're going to be looking to see Wednesday and Thursday what Great Britain's going to do and where the GDP number is in Europe. So that's kind of where we're sitting right now from a reporting perspective. If we look at, and speaking of inflation, I saw this and I wanted to pass this on and just kind of show you. There's two lines on this chart, that red line and then that looks like a green line, or I don't know what color that is. But that line, the red line, is the prices paid of manufacturers, and you can see the price they pay. It's the ISM Prices Paid Index, which basically measures, like I said, the cost of input costs that producers buy their goods and services, and then they turn around and then they sell them to folks like us. That price has been going down really since the beginning of 2011. The price has been going down. But look at the 10-year yield on the 10-year U.S. Treasury notes. That is that light colored line. They go hand in hand. So there is, and the takeaway from this chart is that deflationary pressures, or lack of inflation, is generally measured by CPI and PPI data. They go hand in hand. And when the cost of goods and products that companies buy go down, then they turn around and then they sell it to a consumer. Typically those costs stay steady or go down, and that causes a deflationary type of event. And the economy reacts to it by keeping interest rates low. And the lower the interest rates go, the more there is a potential deflationary kind of environment. So you can see this relative relationship. You can see also, what I want to point out here is that in 2008, right here, during the financial crisis in the U.S., all right, it got very bad as far as the prices go, and you can see the 10-year note right here at that level, and we are now below that right now as far as the interest rates go, and that is what's got everybody worried. That's what's got the analyst worried. That's what's got the market participants worried. That's what's got kind of a, right now, why the markets are so choppy. They don't know whether they need to shit or go blind, because the markets, every time you get any kind of move up, it's immediately sold off. So, and the way to fight deflation is to inject a lot of money into the markets. And that is what every country has been doing. China's been doing it. Japan has been doing it. India and other big emerging market countries in the Asia-Pacific area have been doing it. Swinging over to the European markets, Europe, the ECB just did it. They're about 3 or 4 years late to the dance. They're doing it. Great Britain's been doing it. Everybody's doing it, except for now the U.S. has stopped putting money into the economy. And we are looking at, in fact, there's talk now of raising interest rates by 25 basis points, which is 0.25%, sometime in the early summer months, June on. And now there's talk, based on the report that came out this Friday, of our employment data and just the strength that it seems to be showing, and I get the fact that you can juggle with some of these numbers, and our true unemployment in the U.S. is probably closer to 10% instead of the 5.7%. I get that. But the data still shows overall it's improving. So that puts more pressure on the Feds to raise the interest rates, which is exactly what you don't want to do when you've got this kind of environment right here. So they're in a pickle. So this is why we're getting a lot of chop right now. Do we raise interest rates? Because when you start to raise interest rates, that tends to do what? It tends to drive down any potential inflationary effects in the market. It tends to drive it down. However, we want to drive inflation up. That is the whole purpose of stimulus. For 4 years, 4+ years, that's what we've been doing, and it has not worked. Inflation, in fact, you know, when they started doing the initial stimulus, you can see how it did move up dramatically over a year and a half or two, because it was kind of a shock to the U.S. system with all that money. No one else was doing it. The U.S. was the only one just putting a ton of money to the tune of over $1 trillion in the U.S. market. But then after a while, that stopped working. And we still here kept adding money to the markets or to the economy, yet inflation kept going down, okay? So now they're in this pickle. And when you put all of this together in a punch bowl and you mix it up and you drink it, they don't know if, like I said, you're going to shit or go blind. So it's going to be, we're kind of in an unknown, because the central banks have never put this much money in an economy before. And now they're trying to walk a delicate balance of, do we raise the interest rates very slowly here in the U.S., and how do we do that? And they may, in some Machiavellian sort of way, be helped out a little bit by Europe. And that is what's kept the interest rates right here at an all-time low, even though QE really stopped back over here, okay? And it kept going down because Europe just started doing their QE over in the ECB. And as we've said on a lot of our sessions, our pre-market sessions, a lot of that money from the Europe is coming over to the U.S. into our treasuries, okay? They're coming into our treasuries because over in Europe, you got anywhere from a minus 0.05% to about a 1.2% yield on most of their securities. And that includes Italy and Spain and some of those really egregious countries that have a hard time paying money back. It's very low over there right now. So you're sitting there with $50 billion that you want to park in a government security for 6 months or a year and just kind of sit back a little bit. Where are you going to put it? Somewhere where you can get maybe 1.2% or 0.8%, or are you going to put it in a U.S. government security where you can get 1.6%? Well, I don't even need to answer the question. You're going to put it where you get 1.6% at lower risk because it's a government security. So that's why all that money is coming over here, which drives our interest rates down, even though the money in the U.S. has stopped flowing. So that kind of confounds a lot of people. But now you've got an idea of what's going on. And when this money comes from Europe over into the U.S., it does it via U.S. dollars. They've got to exchange euro for U.S. dollars and then use the dollars to buy the treasuries. And by doing that, that drives the dollar up even further. Okay, so we've got, it's not a small world anymore, Alice. It's a big world. And what happens is that everything that every country does has consequences for other countries. It's not like investing back in the 70s and 80s where you had a trading platform and all you really cared about was IBM and that was it. and you didn't follow anything else. Well, now it's a lot more intricate, and I wanted to spend some time on this because I get asked this question all the time. And it's important that you understand this. And when you understand this, you will become a better trader, even if all you're trading is equities. You need to understand where and why bonds are doing what they're doing, where and why currencies are doing what they're doing. You need to understand this because currencies and bonds are about a 10x factor size in relation to equities. Okay? Equities are very small compared to bonds, all right, our currency market. And the money is constantly flowing from one channel to another in search of yield, money that I can make. And money flows from bonds and currencies because sometimes to buy bonds, you got to convert your currency to buy the bond in the country you want to buy the bond in. And it drives equities. And if all you do is concentrate only on the equity market, and that's the only area where you're trying to focus, you're crazy because this guy up here drives it. That's kind of like saying, well, let's focus on where the caboose is going on a 5-mile long train. And what you need to do is focus on the head of the train so when it comes to a fork in the road, you'll take it. I hope you guys are trying to, and now our group, we trade bonds and currencies and equities and futures, commodities. We trade all of it. But you need to understand it, whether you trade it or not, to understand the equity market. Okay, we took a trade this Friday based on money flow. And we basically went into XLU, which is a large sector ETF of the utility market, which tends to be capital intensive, which tends to follow the bond market. And when bonds start falling, then generally XLU will start to fall. When interest rates start going up, XLU will start to fall. Also, XLU is a place of safety and comfort. When you've got trouble around the region or globe, XLU is very strong. We'll look at that in a minute. But this intermarket analysis is so important. And there are, it takes a while to kind of put all this stuff together, but you got to understand it. In our group, that's where we focus. Okay, so anyway, I wanted to show you this chart just to kind of give you an idea how things are flowing along. If we look at the year-to-date performance for 2015, even though these look like big, tall numbers, they're not. You can see NASDAQ is up. Now, this is the cash index. I will say the futures market is low, is not. We're still underwater in the futures. I'll show you the charts in a minute. But on a relative performance basis, you'll see both NASDAQ and the Russell above water, the Dow slightly, and the S&P, the SPX, the cash index is underwater. Okay? Let's take a look at, so this year has kind of been marked by even higher inflation, and I will show you that in a minute. If we look at the relative performance of the major sectors year to date, okay, so let's just look at it from January 1, at January 2nd, which is when the market's open. You can see the material sector right here. That would be XLB, all right, as a sector, is really outperforming a number of sectors. And this is a real interesting play here. Healthcare right here, which is XLV, is a flight to safety, but a big part of this is the biotech, because biotech has been doing very well in 2015, at least so far, which is a big driver of healthcare right now. Consumer staples is right here. That is a risk-off kind of environment. That's, you know, the tobacco companies, big major food, Procter and Gamble, those kind of things. That's sitting right here. Now, what's really interesting also is cyclicals over here, which is XLY, also called discretionary, which is, you know, over the past week or a couple of weeks, it's really moved up dramatically. And you can see energy right here, XLE, which is bouncing off of a very strong low that we've just, you know, the market's just, for energy over the past 6-8 months, you guys know it's fallen about 50%, okay? Utilities right here, that one is utilities, and then finance right here. Finance has been very bad, XLF, year to date, because interest rates are so low. I believe over the next 30 days, you're going to see finance do a lot better. I think you're going to see utilities get worse, okay? So I think you're going to see that get worse. And I do believe that you're going to see discretionary do a little bit better as well, okay? I think energy, it's a little bit of a question mark. We have been playing energy. We've been playing energy to the upside. I've been playing it via XLE, all right? XLE has been outperforming oil. XLE is the sector ETF that is comprised of refiners, producers, service providers, a number of different oil patch companies, and as a group, they have been dramatically outperforming oil. Although oil is trying to find a bottom now, and we've played both XLE and oil nicely this year, and we're going to see where this goes. And we just got into, as I said, XLU this past week, and we just got also into playing bonds to the downside. I am short bonds, but TLT also had a hard move to the downside. TLT is an ETF that goes generally in the direction of bonds, okay? TBT is a double inverse. TBT tends to go up when interest rates go up, okay? So there are a number of different plays to make depending on your cup of tea. All right, and 2015 is going to be a good year. Volatility's up, but there's going to be some changes in the market as to what are the sector leaders, which ones are going to start to perform better for 2015, and which ones are going to start to give it up. Now, mind you, in any given 30-day period, we're going to have some volatility spikes where trades are going to go against those primary movers longer term, but you need to understand that, okay? So that's a little bit about where the sectors are lining up. Now, let's take a look at the rotation, and I know a lot of you have seen these because we use them all the time. Some of you have not, but what this is a sector rotation chart, and in the sector rotation chart, in the center here is SPX. All right, that's SPX. So everything is measured on a relative performance basis against the S&P 500 cash index. All right, and this is the leading sector, meaning they're outperforming the SPX. This is the improving sector right here, weakening sector here, and the ones that are really bringing up the rear here. You can see energy is on a 90-day basis. Each one of these circles represents the location of that particular sector during that week against the SPX. Energy's constantly been underperforming the SPX, but look at what it's doing. It is slowly moving steadily straight up. Now, we got into XLE about 2 weeks ago when it was down in this area here, as it clearly started that turn. Okay, maybe 3 weeks ago we've been in XLE, but you can see how the sector rotation tends to go like this. As you can see on these tails, because I've got them out here for 12 weeks. I've got a 12-week tail on here, so you can track where that sector's been over a 12-week period. So you can just see how things tend to flow. And this is on each one of these little circles here represents 1 week in time. Okay, it's a 90-day rotation chart. You can see also on this 90-day rotation chart where XLV healthcare is pulling back a little bit. Staples is starting to pull back. XLU has just started its move. We just got into that trade. That one is probably going to gradually work its way down here, just like XLE is gradually going to work its way up there. All right, so we got into XLE down in this area here to ride it up here. We got into XLU up here to generally hopefully ride it down here. You can see transportation is coming down. IYT, it's a sector, or sector of the transportation. And it's coming down primarily because energy is moving up, which means cost of gas is going to go up a little bit. So there's a little bit of a reflex bounce to the downside on transportation stocks. You can see technology is still underperforming a little bit. Finance down here as well. Industrials down here, but we've had a nice move here with discretionary. And there's materials. Remember I told you materials was doing well for 2015. So when we look at investing and where we want to be, we don't really care, or you shouldn't care, unless you're, because we got a lot of members that are with IBM and other companies where you've got 401k money and you've got money in stock in those companies, and some of you, have a large amount of money tied up with some of these, and I'm trying to encourage you to hedge those bets. But what we want to do is follow where the money goes, okay? So let's break this down and let's go into a daily rotation so that we can go out for the past 2 weeks and see how this looks, okay? If we look at the sector rotation for the past 2 weeks, well, now it paints a completely different picture. Look at who's leading the way. Surprise, surprise, energy, way up here. You can see discretionary has come on. These two guys right here are indicative of an economy that's growing, energy and discretionary. People don't go out and buy big screen TVs and snowmobiles unless they feel a little bit more comfortable in their job. All right, and energy is growing, even though the inventory levels for oil are at all-time highs and the production is at all-time highs. The theory being the more the producers produce, because consumers are buying, the more energy is expended to produce what they produce. You can see XLF banking. It has slowly been coming up here every day. It's improving. Why? Because interest rates look like they're starting or will start to rise, and bonds are starting to go down, which is why we entered into a TLT trade. Now, I'm a permanent short in bonds. I've just been short bonds for quite some time. But for those of you that can't trade the bond market or don't want to, TLT is a good proxy for that. There's materials up here. You can see where materials is. It's still in a leading sector here. Now, the other thing I wanted to show you, here's XLU. And you can see here, every circle here represents 1 day in time relative performance to the SPX. Okay? You can see we got into XLU just recently, but look at that. I mean, it is going to slowly work its way over in the corner down here, which is where energy had been for a long time. You can see the flow very visually on here. That's why I like this. Now, I was doing this kind of analysis with ratio charts, but this makes it a lot easier to analyze. A ratio chart is, let's say, when you take XLP and divide it by XLY, which is kind of you've got risk off right here, right? There is no risk. And then you've got risk on down here. So you're measuring risk off divided by risk on. And if the chart is moving up like that, that means that risk off is now the nature of the market. And if the market is moving down, that means risk on is the nature of the market. So there are a number of different ways to measure this kind of analysis, but this sector rotation chart makes it so much easier to do, okay? So much easier to do. Now, commodities. Well, you guys know we love commodities. Commodities tend to trend. They can be volatile on a week-to-week basis, but they tend to trend. And you can see here over a longer period of time, natural gas, I've been short nat gas. You can see gasoline and oil just now starting to come up off the bottom. There will be fits and starts, but I believe they're going to work their way back up into this area here. And it may take a year or even more to get over here, and they may not ever get over here. They may come back up and roll back down. But the odds favor these guys to move up a little bit. Hence, I have been in and out of gasoline futures to the long side, and I've been in and out of oil to the long side. Gasoline futures, you can trade UGA as an ETF proxy for gasoline futures. Oil, you can use USO, which is the primary proxy for oil. If you don't want to trade oil on almost a like-for-like basis, you can trade XLE, like I'm also doing, as a proxy for the energy market, okay? So these are some of the things that I'm seeing here. Now, we've been right there. There's lean hogs. It started here. It's out. We've been short meat for quite some time. There is live cattle right there. You can see they've come down as well. Cattle has fallen down. We've been in and out of cattle. I haven't traded cattle in the past 4 weeks, but it has been a great trade for us towards Q4 of last year. We did very well with the cattle trade. You can see silver and gold. We've been long silver and gold earlier this year. You can see how they've moved up, and then you can see the ag market really did well until starting in late November, December, and now they're just selling off dramatically. So again, a really great chart to kind of look at how you make your bets. And let's say you do not trade commodities, you don't like commodities, but you want to know that oil and gas is down in this area here. You may want to take a play in XLE or UGA or USO. Natural gas, UNG, you can take a trade in that one. So there are ETF equivalents where you can play these markets. So this and commodities do tend to trend, just like currencies tend to trend. So we play with these, and they're fun. And I think we're going to have another good year this year the way it's going. Countries, we talked about this as well. I said on a relative basis, Europe will probably outperform the U.S. And, you know, we're getting Italy and Germany. And we're seeing Japan and some of the emerging markets, or Spain, doing really well. Here's China over here. They've had some good numbers come out. Again, this is on a 90-day basis here. You can see, and here's Russia down here. This is like a dead cat bounce for Russia. But you can see Brazil and Latin American markets. All of these, again, are in relation to the SPX. SPX is way over here on the right. So when you get it, you know, that far over here to the right instead of in the center right here, all these guys are just really underperforming the U.S. markets. But the ones in Europe are doing very well. And I said on a relative basis, Europe is just starting their stimulus. The U.S. is just going off their stimulus. But I think Europe's going to have bigger problems than people suspect. So we'll talk about that, members, as we start going through February and March. Transportation sector. If we look at just the transportation sector over the past 2 weeks, you can see here where most of the airlines now are starting to underperform. United Airlines, Alaskan Airlines, Southwest Airlines, JetBlue. You can see these are starting to turn back down. Kansas City Southern, Conway, some of the rail lines I do like. Northern Pacific, I like the rail lines. Union Pacific, I like the rail lines better than I like the airlines right now. Okay, so these are the ones that I like. Industrials, Boeing had good earnings. You can see over the past 2 weeks they're doing well. Honeywell, 3M. But that's about it in the industrial sector right now. Caterpillar, lower laggard, way down here. So I would look at that more as a contrarian play. Caterpillar is a good measure of global growth as far as industrial mining and big production equipment, and they kind of go where China goes. They're not doing very good. So I would just kind of keep that in the back of your mind. Boeing is the best in the industrial sector. 3M and Honeywell also good. Energy. Well, lo and behold, I remember showing this chart to you guys 6 weeks ago, and it was just the opposite. Put it in the mirror, and all of these were in the red in the lower left-hand corner. Now energy's doing very good. Valero, Pioneer, Rig, Apache, Schlumberger, Halliburton, Devon Energy, Oxy, all these guys. Now, I didn't want to try and make a bet because my luck, the way I do it sometimes, I'll say, gee, I think this guy is going to be up at the top, and he ends up down here, and I bet this guy is going to be at the bottom, and he ends up here. So you've got, even though they're both in the energy patch, one is getting killed and one is doing really well. Well, the best way to play that is XLE, which is more of a consolidated view of the entire market. So when the entire market, or let's say, more than 80% is outperforming the SPX, you don't want to be that knucklehead that picks that one or two that are down here and you're watching everybody else move up. Believe me, it happens. So that's why I went to XLE. Now, I could have also, I do like Schlumberger. Believe it or not, I like Halliburton. I like Apache. But they tend to have more beta to them, which means they tend to move a lot more. They dance around like grease on a skillet, and I would prefer right now to just be an XLE. So this is a where you do that. Yeah, Lewis asked what software produces this type of chart. It's really good. If you go to stockcharts.com, okay? Stockcharts.com. And you can get for free, you can't do this for free. You only get like 2 or 3 canned ones. But if you join their service, then it will allow you to go in and benchmark any sector rotation you want. All right, and it's not expensive. And I use it for the rotation primarily. They have a couple of other good things that they do as well, but for rotation, it's invaluable. Do you need this to be successful? No, but it does make it a little bit easier for you if you have it. So that's, Lewis, that's where that came from. Okay, let's look at discretionary. Well, discretionary, Amazon, Starbucks, Coors, Lennar, the home builder, Netflix, all these guys, you will see here the thing that concerns me about discretionary right now. Remember you saw discretionary was doing really well? If you look right in this area here, this is where almost all the discretionary is. And right in here is the SPX. So when they're grouped in the center, they're not performing better nor worse than the SPX. Those that are driving discretionary higher are these guys right here, which have had earnings through the roof. So you got to be careful about chasing a sector like this that's only driven by just a few stocks, because I want to see a lot of these guys up here. All right, I mean, to give you the difference, to show you the difference, well, and you got to be able to look at this and see it, but look at the difference here. This is the energy sector. Now that one is not being driven by one stock. In fact, you got one or two stocks down below, and you got one or two in the center, but you can see them all grouped outperforming the SPX. But in the discretionary, you have just a few outliers, and then everybody's grouped in the center. So that tends to skew discretionary, if you look at XLY, to make it look better than it really is. Discretionary is a risk on environment. Like I said, people don't buy flat screen TVs and jet skis and things like that unless they feel comfortable in their job. So just be careful that you don't, you want to get them skewed. Now let's look at financials. Financials is another one, guys, that we want to look at, and we want to lick our chops and say, hey, there may be some good opportunities in financials. Remember, financials really got killed with low interest rates. But look at this. I mean, it is, they're just almost in tandem. You can almost see them moving over here over the next 2 weeks. Citicorp, Goldman Sachs, BAC, Bank of America, Zion, which I like, ICE, Wells Fargo is probably one of the better managed financials out there. NASDAQ, BB&T, JP Morgan, MET, MetLife. So these are very good. And what, again, like energy, you may say, you know what? I'm just going to take a flyer in XLF. But because you've got a relative performance basis, almost all of the financials moving up, you could probably come in here and say, well, I like Citi, I like Wells Fargo, and I may do maybe a Goldman Sachs or a JP Morgan as well. So there are different ways in how you can play this one. A more conservative play is XLF. A little bit more beta adjusted, a little bit more juice to it would be to come in and pick, like Zions, which is a regional bank on the West Coast, or Citi, or B of A, or Bank of America, or Wells Fargo. If you were to choose one stock and just limit it to one, which would kind of have the best of both worlds, Wells Fargo is probably the best one in the banking sector. But then you can add more juice to it by going to Goldman Sachs, which tends to bounce around a little bit, or Bank of America. But bottom line, you can just see the improvement here on this chart, right? I mean, it really is nice how it shows up. Okay, so if we come over, and let's just get this off the screen here for a second. Technology. I'm not impressed with technology. The only one that impresses me with technology is Apple. SanDisk is okay, but basically they're all kind of bunched in the middle. Apple, and that was one trade that, quite frankly, I did a rat brain move on, but I got out of it. I stuck to my parameters. I was long Apple about 3 weeks before earnings. I said they're going to blow their earnings out. And I projected a high-end price, which is where it seems to be going. But Apple was selling off. It was very uncharacteristic. And then I waited for the retail sales numbers to come out, and they came in lower than expected. So I said, all right, well, there's a lot of juice built into Apple for a big Christmas season. But with retail numbers down, then it could be that Apple's going to, even though they report outstanding numbers, the market's going to sell them off. It did just the opposite, and Apple did very strong. So I got out of that trade when I should have stayed in it. But that's okay. I just trade my plan, and that's all you can do. But that is really, Apple is the only one holding up the markets in my mind. I saw some report that said if Apple had crashed or stayed steady or gone down, then the NASDAQ, because Apple is a large percentage of the NASDAQ weighting, NASDAQ would be underwater right now. So you just like the other sector I showed you where discretionary, where just a few stocks like Amazon and Starbucks and Netflix are holding discretionary up, be careful with technology as well. We do want to see technology start to lead. We need them to lead because that is a sign of a healthy economy. Materials, there's really nothing here in materials. Now, you saw that they were doing well. The only ones that, and I've traded this to the downside a lot, now it's getting a bounce, is U.S. Steel, Owens, Illinois here. But I do like Dow. The one in the materials that I like the best is Sherwin-Williams. Now you can see it's down in this area right here, which means it's performing, most of these right here are performing in line with the SPX. But I do like Sherwin-Williams the best, SHW. And Dow, DOW, is a good one too, Dow Chemical. So those I do like. U.S. Steel is more speculative. It has fallen so much. I've been short that stock for a while. I got out. I shouldn't have, but I got out around $30 a share, and now it's down in the low 20s or something like that. I started shorting it at like 45 a share. But Dow is really the one that I like the best here. So in the materials sector, Dow and Sherwin-Williams are the two that I like the best. Probably less beta with those guys, but those would be the ones I would select in that sector. Okay. If we move over to healthcare, well, again, like discretionary, the biotech, which BIIB represents, is kind of holding healthcare up. You can see everybody else is not performing as well. Okay, remember SPX relative performance is right here. So be careful with healthcare. I think we've had such a good move. I think you're going to see in 2015, while biotech, you're going to have individual winners. I think as a whole, it's not going to be like it moved in 2014. So you just have to be careful with that. And biotech is kind of keeping them all up. Consumer staples. Well, it's moving in the right direction. All these guys down here, because that means risk is coming back into the market. Costco is just through the roof. I think Costco could be a nice contrarian play where you play it to come back down. Remember, anything that gets in these categories up in the area here generally move away from the category. And for Costco to move away, it's got to underperform a little bit. It can still outperform the SPX, but on a relative basis, it's going to underperform, which means you can play a bear call spread by coming out of the money and shorting a call and going along a call, the price, which would be down here. Okay, so you could just choose a strike price with a vertical seller credit spread above the money here. So, you know, that would be another interesting play with Costco. And we'll look at the charts. I'll show you what I mean in a minute. Utilities. Well, we got into utilities. And this is, again, what happens when utilities exits stage door left. All the utility companies, every one of them. Now, 3 weeks ago, this is where they all were right here. And the tails look like this. They all were up here like this, all the utility companies. And then all of a sudden, over the past 2 weeks, what do? Money comes out of utilities. Interest rates look like they're going up. We got in and played it by going short XLU. Now, I think they're going to move from here over into the red, so I don't think the underperformance is done yet. I think they can still move down even more. So that's the utility sector. Let's see. Okay, let me just freeze my screen for a second. Grab a drink of water. Because my voice is getting a little hoarse talking to you monkeys this morning. Let me just save a few things, and we'll go take a look at the charts here. And then we'll just get everything going. If you guys have anything you want me to look at, specifically, we'll go take a look at it. All right, let me get the chart back up on the screen here for you guys. Okay, where are we? Here we go. Chart's coming up. Now the chart is going to go from white to blue to the chart because that's just the way it works when I have to work with this WebEx software. So just understand, every time I make a change on the chart, it goes from white to blue back to the chart again. All right, let me show you what we got going on here. What you see, I've got a lot of colors working this chart. I'll explain them to you. What we've got right now, you can see, and let me just get my color pen. Let me just change the color of my pen. So what you can see here is we were in this channel to the downside. You can see we took out a prior pivot high right there. So it has now got a new 2015 intraday high of 2068 for the E-mini S&P 500 futures. This blue line was the opening price of the E-mini futures, and right now we closed at 2056. So we're slightly up above it. It doesn't look it, but we're slightly up above the opening high, just barely. Now, the closing price, remember, when the markets closed at 4 o'clock, the E-minis were below, and then over the last trading hours, it actually moved up above is what it did. So that's why we're showing just slightly below here the actual closing time, even though it traded a little bit beyond that. So we want to hold, this is a psychological barrier, their opening price of 2015. So now we've got this new pivot high here for 2015. And this green line here is the all-time high of the E-minis of 2088.75. The low for 2015 is this pivot low down here. Okay, so these are the colors of the chart, just so that you understand what the heck you're looking at. Now, what I want to show you guys is, let's just do this for a second. Now, how do we know when this down move is over? Well, we got to start taking out a couple of key things, all right? What we've got to do, now that we've got a new pivot high, we took out that pivot high, we got a new pivot low, which is right there, all right, which is just north of 1970. It's just north of that. 1970.25 is the low for the year, 2015. So notice how wide it is, right? That wideness is reflected because we've got a lot of volatility in the markets. I mean, we've moved from the top of the channel to the bottom of the channel, to the top of the channel, the bottom of the channel, through the top of the channel, near the bottom, in just a very short period of time. I mean, we've been very volatile this year. For buy and hold traders, January was a hard month for you. You may now be just net up $1 or $2 on the E-minis, yet during the year, it's been during this quick year, it's been very, very painful. Just up and down, up and down. We've got to break this cycle. The only way to break the cycle is take out a prior pivot high, have it roll down, form a new pivot low, and then start working one of these kind of things like that. And then you're going to see a change in channel as it starts to move back up, right? Now, that is one scenario that can play itself out. Another scenario, which I think is a little bit more likely, is that we did take out that pivot high. There is a lot of resistance here, as you can see, okay? A lot of resistance, as you can see. As we come, and this upsloping channel right here also is acting as resistance. I believe we may come down, stay north of this price right here, and enter into one of these classic choppy modes where every up move people think we're bullish and every down move people think we're bearish. But until we break these boundaries, we're just going to be in a wider version of a dead man's game, which is chop. Okay? And until we take these out, that's where we're going to be. For me, what would define a classic uptrend? Remember, these are classic definitions of how the market moves. You need pivot highs and pivot lows. You need new pivot highs, new pivot lows. So we got a new pivot high there. Let's say we come back down and we get somewhere here and it clearly starts moving back up again. So now we got a pivot low. And we need to come back up, take out that pivot high. I don't care even if it's by $1, and then come back down, and then we'll do one of these things here like this, and it starts moving up. Now we'd have 2 pivot highs, 2 pivot lows, and that would be making of a new channel. the vector of that channel may not be the vector of the way we've been for the past 3 years, but it would still be an up vector. If we do not make a new pivot high, then that gives us a flat base at the top, or a flat resistance level at the top, and then we just have to watch these pivot lows. And then if we're just constantly doing this, then the vector is a sideways chop mode, okay? These are two scenarios that can play themselves out. Another scenario that can play itself out is, yeah, we come up here, but we do one of these kind of things, and then we take out this pivot low here, form another low here, and then start working our way back up again. So now we got a new pivot high right here, and a new pivot low there. So now the range is wider. And typically in those patterns, you know, it's like a megaphone pattern where you do one of these kind of things like that. That's like a megaphone pattern, and that just means volatility is going up, and these things can be brutal, which means you can keep going lower, and it suckers everybody in because you're making new highs, but it's taking out prior pivot lows and forming new pivot lows. So any one of these scenarios can play out, and if anybody can tell you which scenario is going to win, and they know for a fact, they're screwballs. All we got to do is take it one bar at a time, and notice on this chart right here, we're using a day bar, which is kind of the industry standard for just measuring trends, right? Within a day, you can find intraday trends up and down, but you want to generally go in the direction of the overall trend. Right now, because we broke that pivot high, now that would tell us that we are just about in a mixed condition. You can see by the DIs down here, the DI minus is still over the plus, the 4 is over the 12, so that means that's up, that means that's down, and when you combine these two guys here like that and you add them together, it gives you a daily which is basically mixed, which I don't need to tell you. You can eyeball it and say, well, it kind of looks mixed to me. So that's kind of where we're sitting right now. And in a mixed condition, you got to do what every rat brain trader hates doing, and that's wait. Now, for those of you that want to put on positions and trade near term, what do? We go into the 2-hour chart, which is a good X-ray vision of the daily. And you can see right here, we did not have a good end of day. I mean, we went, let me put it on a 15-minute chart. Looking at this 15-minute chart here, you can see where the day kind of opened right here, or where it closed, but the day opened right here. We were kind of hovering around the 2055 opening price, and we kind of stayed here pretty much until markets open. We got the report out at 8:30 in the morning, right? And we bounced and we moved up, formed a new pivot high here, took out the prior pivot high. But then we spent from about noontime on going down. So that is not a good sign, folks, when you spend the rest of the day going down. And then as we went into close, there was a little bit, we went into close right there, which is below the opening price. But then in over 9 hours, as we went into the weekend, you can see it moved up just to come back and recapture 2055 again. So that movement right here in the last half of the day on Friday is really not a bullish movement for price action, okay? I mean, it really isn't, because you can see here we actually were underwater compared to where we opened the day right in that area there, okay? And where it closed the day before right there. So just not good price action. The markets are still have a lot of overhead resistance in them, okay, is what I'm saying. So you got to be very careful. And I will adjust this once we move forward in time to see how this thing plays itself out. If we come down and look at the volatility, Remember I told you this year volatility is higher than it was last year. What I've done is I've put in a box right here 2015. Look at volatility for 2015. You can see right here already from last year we've been in this box, in this range for volatility, and it's been high, right? I mean, I don't need to tell you. You probably just intuitively figure that, because for most of 2015 for Q4, and with the exception of just a couple of peaks right there, we've been below this entire area, going all the way back. And now we're stuck right in this area right here. Normally volatility, last year we would get a spike in volatility. It would come up and go down. It would come up and it would go down. And this is a daily chart. So this spike would last, about a week's time, about a week's time. And then it would go down. Now we've been in it for this long, and we're still in it. We're right at this range right here. So volatility in general for 2015 is a lot higher. I don't need to tell you, as I said, you probably can feel it. But I think when you see it on the chart, it kind of comes true. So we're going to watch that. If we look at the bond market, the bond market has really been selling off. Look at this. I've been short bonds, probably, and just been suffering like all the other guys that have been short bonds. Right at the beginning of 2014, right there, bonds just started going up. And remember, this is around when, they said they were going to be stopping QE. They're going to be, the U.S. is going to stop doing that. And everybody thought bonds would just start going down from right there. And what did bonds do? They went up. Why? Because now there was pressure on the ECB to start doing their stimulus. And before they started, money started flowing into the bond market from Europe and from Japan. We've talked about this. So you can see this channel, bounded by this shaded zone area here. And we were here for quite some time. And then it just gave it all up in one shot. We're sitting just above the 50 EMA. I said bonds would probably find its way back into the center area here. I just didn't realize it would do it in 2 days. Now, fortunately, I'm in the trade, so I would have missed it if I was not in the trade. But we're going to find out if it can come down and break this area here. I'm going to add to my bond short, and we're going to come down and hit that key area there. Remember, it's $1,000 a point in the bond futures market. So just this one move from here down to here was about $5,000 per bond contract in the futures market. So you can make good money if you can trade futures. You can also see here that, well, no, you can't see it. Let me get this off the screen so it doesn't look like Charles Madden has been diagramming a football play on here. If I blow it up, the other thing that just happened on here, lo and behold, the 4 is underneath the 12. We got a down signal. The DI minus is above the DI plus. We got a down signal. We got down, we got confirming down. You put the two together on a daily chart, what do you get? You get a down, okay? So this tells me that the bias is shifting in the bond market to a down position. Now, I played it a number of different ways. I'm short bonds. I also went short XLU via ratio diagonal that I shared with our members on our chat room. So there are a number of different, or you can do, and I did a ratio diagonal on TLT as well. Okay, it will be choppy, number one, and number two, it probably will not fall as far as everybody thinks initially. But when we start getting whiffs of inflation in the market, this guy is going to start coming all the way back down. You're going to see, let's put it on a weekly chart here. You can see the area where it's going to come back down, guys, is probably, and it's going to do one of these kind of things like this. So it's not going to be pretty, but it's going to be a channel like this, just like that channel right there. And it's going to get sandwiched right in this area here, okay? And this was here for almost a year, you know, about 8 months. So it's going to get here because that is a big pivot right there, a huge pivot. So I do believe it's going to find its way back down here. Now, it's at 147 and 13 ticks now. Down in this area here, let's say it puts it at 130, okay? That's 17. That's 17,000 per contract when it makes that move. Now, again, that move may take, you know, 8 months. It may take a year. Remember, this started January of 2014, and we're in February of 2015, so that's 14 months. Things tend to fall faster than they move up. If you look at this move here, from here down to here, which is about where we are right now, right? It started the move in April on the 4th month of the year, and it finished it in January, which is so call it 8 or 9 months. So 9-month time frame, we can wind up back down here again, giving up all of those gains or all of these moves here. Now, I traded that move down, and then I just assumed it was going to stay in this area here and then break and go further, which is what all the other bond traders thought as well. But it did not. It started moving back up again. We've got this wide separation on a weekly chart, so we're going to get a snapback on the DIs. So, and that is kind of where all of this is here. So let's see, Manu G, I'm new to this and was wondering how come in all the indicators you use, you seem to ignore volume. Wouldn't I trend back from high-low volume? Manu, I do use volume, but I use volume as part of a confirming indicator, okay? I don't use volume as a trigger. And I can come over here. Well, let's get it back up on the screen. Here is volume right here. Okay, and you can see on this volume, anytime you get a big move, I'm going to go over and I will look at volume on that one chart or that one. Now remember, we're on a weekly chart here. You can see volume up at that level right there. And if I were to draw a line like that, you can see that was a big area of distribution right there. And volume, we're still up here, so everybody's kind of trying to make their mind up. But we break that key channel right there, and we go down, and volume is up in that area there. I'm going to be part of that volume, and I'm going to be playing it to the downside, okay? Also on volume, one of the things I also do, notice I've got 2 lines on my volume chart. I've got a 5 and a 20. So just like people track moving averages, I'll track a moving average of the total volume. And when I get a 5 crossing the 20 to the downside, that says volume is coming in a little bit. Notice 5 cross 20 to the upside here. So volume is picking up as it's starting to come down. So that's kind of one of the things that I look at. I'm concentrating right now on not the confirming triggers, but the primary triggers, Manu. So that's kind of how I'm looking at that right now. But this is bonds, okay? All of this stuff ties together. And again, this is a weekly chart. So this is kind of how I'm seeing this thing flying here. Now, if we come in and look at currencies, well, guess what, guys? This is a daily chart of the U.S. dollar. We've been long the dollar. We've been in and out of the dollar for quite some time. You can see this sucker is just, it's like the ever-ready bunny. It's like a gift that just keeps on giving. And now we're sitting here at this level right here. It's doing very well. It responded favorably to the report coming out on Friday, naturally, right? I mean, if we look at the dollar, it was on fire on Friday. Look at it. The report hit at 8:30, and bam, away we went. A little bit of a pullback, and then boom. And we just finished near the highs for the day with the U.S. dollar. Really great trade. We've been long the dollar. Now, the one that we took, which was interesting, here is the British pound. I love the pound to the upside. You can see here the pound comes down, consolidates, comes down, consolidates, as evidenced by these areas here. I do believe, and I'm not long the pound long term. These were just day trades. We were playing off the bottom. We played a little bit of a break here. In fact, during one of our live sessions, I think Thursday morning, we took a pound trade, and a number of you made some quick money on it. Paid for your membership for the year, I guess. But we're sitting just under the 50 EMA. Now, the Elliott wave count would suggest we're going to come up, we're going to come back down, one final thrust down in this area there, and then we're going to start working our way back up. I don't know if that's going to happen, but that's what I'm going to watch for. If we break and make new pivot highs, create new pivot lows, and start up, the pound is a choppy son of a bitch, but it moves it trends for a long period of time. You can see how it trends. So you can see this trend to the downside, and by the same token, if I condense the chart, you can see the trend to the upside. And we've pretty much given up just about everything that the pound made from that. My lines are not as straight. Well, shoot, that really sucked, didn't it? But you can see here that line right like that, right? And it's pretty much, we're back down in that area there, which is where we've got a lot of support there, okay? So I think it's going to be hard to break this level, and that's why I think it's just going to be choppy as hell until we start a movement back up again. So we want to be long when this happens. Understand there will be some counter trend moves, but we love these counter trend moves because if we're long, that's where we add to the position at the end of a counter trend move using our charts to find these positions. Now remember, with the British pound, you can be long the futures, and you could play the British pound that way, or you can trade FXB, which is the ETF that follows the pound. Okay, so there are a number of different ways to play the pound. We do love currency trades because currencies tend to trend. Just like the bond market, it tends to trend. You may not like the trend, but that's the way it goes. If we look at the yen is coming down to, we haven't seen these lows in quite some time here, but you can see the yen I don't know if the downward move is still over with in the yen as well. I think it can come back down, take out that pivot low there on early December, and come back down a little bit lower. But the euro, which moves opposite of the dollar, it's coming back down. The euro had a bad day on Friday, just like the dollar had a good day. I'm short the euro, playing it in futures, options on futures. You can see my target for the euro is right in this area here. Now it kind of calls for a range somewhere in this area here, because it not only gives you a target price but a target time, which would put us in the summer months, all right, for finding a low in the euro. We're on a 3-leg. That would suggest a little bit of a bounce, which is kind of what it was starting to do, form a little bit of an Elliott wave 4 rollover for an Elliott wave 5. Now, if it takes out this area here, we're going to come down to parity, which is down here, okay? And that can be very, very likely with the U.S. With the euro. And we've been bearish the euro. I'm kind of a perma bear in the euro. I don't believe in the euro. I think it's like herding cats, and I know we got a number of folks on that are in Europe right now, but you guys, it's like herding cats. The northern countries are more fiscally astute. The southern countries are more socially astute. So it's just, I don't know how you're going to bring all that together in a fiscal and monetary banking policy, but we'll see. So those are the currencies. If we come over and we look at gold, we've played gold to the upside successfully this year. Gold is a difficult trade, and you can see it just, after that big day on Friday, it just gave it all up. You can see that that pattern right there, you would say, okay, that looks like a bear flag. The odds favor a break to the upside. The Elliott wave count calls for a move back up into this area, and my original target was around 1340. Okay, that's what the charts say. But if you're not in gold and we have that break, that would be an interesting trade to take. But, you know, gold could just give it all back up, come back down into this area here, and then be damned the Elliott waves and the patterns and everything else. You have to take it a day at a time. I'm not in gold now. We played this trade right here very nicely. Made some nice quick money on that one. But right now I'm out and I'm watching the move just to see how this thing plays itself out. Oil. If we look at the oil market. Well, as I said in the sector rotation, you can see how oil is trying to get off of the bottom. This chart and this pattern, just to give you guys a warning, would indicate we're going to come up. We may even come up to the mid-50s, right? We're going to encounter resistance, and it's going to come back down, take out the prior low, and find ourselves somewhere around the 40 area, maybe a little bit less than the 40, and then we're going to finally get our win and go back up. One final push down. I don't know if that's going to happen or not, but what I do know is that we're going to follow the charts to see, and we're going to dive into our short-term time frame chart, and then we're going to know if we're a buy on a dip or a sell on the rally mode, and that's how we're going to play oil. So for you members, stand by. It's going to be a lot of fun. Same thing with gasoline. We made some great trades in gasoline. Gasoline looks a little bit better. We've actually got a stronger move up in gas. But again, the chart with gas suggests that it may roll over, come back down, hit our support point, take out this low, and then start another move up. We're going to watch it. Gasoline closed just below its 50 EMA. Right there, right now. So we're going to watch gasoline. We've traded this move to the upside and did very well. I know a number of you members did well in this trade in gasoline futures. The other trade, if you don't want to trade the futures, is UGA, is the ETF that tracks gasoline. Okay, so that's the gas market. If we Now, I'm not going to look at the agriculture, the meats, or the softs, but I do want to look at a couple of stocks that I like. I've talked about them before. I'll talk about them again. I think they're good plays. Here's a really good one right here. NXP Semiconductors. Here's a daily chart. You can see right here we had a breakout on Friday. Okay, right there. You can see it was really just a solid break. Watch and see what it does on Monday. If we come back in here again, then just wait. But if you don't want to wait, if you're a rat brain trader, we've also got a 3, 4, 5 pattern, all right, which would suggest we're going to get an A, B, C pattern like that, right? A little bit of chop to be expected. If you like this one, I may not chase it, but I may come down here and do a put and a long put in a vertical spread where you're selling it just south of the market, and just dare it to come down and take out the 50 EMA. As you can see, the 50 EMA has kind of provided support for this thing going back to Q4 of last year. So I think that should not change. I think that relationship will hold up for this year as well. Okay. So that's kind of where that one is. Another one that I like is Lockheed Martin, a military guy. Good chart here. You can see the trend line. The trend line goes way, way back. All right. I mean, it's very apparent. Here's the trend line. Here's Lockheed Martin. The 50 EMA is kind of following the trend line. Every time we get a dip down, it moves up. So Lockheed Martin, daily chart. I like that one to the upside. Ulta, they do salons and things like that. Another really good stock. You can see right here, we had a key takeout of a major pivot high right there. We're sitting right in this area here. We're at a 5 leg, so we can get ABC chop. But you can see here with Ulta, the 50 EMA has kind of served as a buy point for investors, right? Every time we come down to the 50 EMA, it just bounces off of it. I mean, it's been doing that for quite some time. It doesn't get too far away from it too, and that goes back to the summer of last year. 50 EMAs at 128.87. So that means it's a little bit more of an expensive stock. So you could probably come here out of the money and do another credit spread, you know, with puts, a bull credit spread, and just dare it to take it out. Okay, so that would be an interesting trade on ULTA. Another one that I like is AMBA, which is a technology company. You can see here 3-4-5 pattern. It's formed the pattern, but it's stuck in this area here. The 50 EMA is kind of holding up, so you could go out of the money and do that one there. SLXP, I love. It was definitely overdone right here. Earnings are coming up. It filled this gap very quickly right here. Right, you can see where we're sitting here right now on this one. I like this one to the upside. So you can see the 50 cross the 200 again. It's sitting down below, so I like SLXP. Visa, guys, we've been in and out of Visa many times. It's a consumer spend play. It's a credit card company. I love this one. You can see right here it's moving up to my target of 280. You can see the earnings came out. It did great with earnings, and I think Visa looks good. Discover Card is one that I also like. It's not as expensive as Visa. It had a huge overdone downplay right here, way overdone. Just to me, I just think it was just really oversold dramatically. And if I were to put a prior pivot on here, you can see where now the charts seem to indicate we've got a 3-leg, move up to a 4-leg, and then possibly a final thrust down before we figure out what we want to do. But I do like this one longer term. I do. So those are those right there. Okay, let's see. You want to look at FireEye. All right, let's go take a look at FireEye for the wild guy. Our security play here. Let me go find it on my FireEye. I do like that one. I mean, I do like the concept. Here's FireEye right here. You can see right here the Fibonacci's extension off the low. We're trying to penetrate the 200 EMA right here. I do like it to the upside. I do. I like it to the upside. So FireEye, I like. Ford, also, auto sales are doing really well. So Ford should be no surprise, is moving up. You're going to see right here with this gap that I think it's going to hit that. Now, it's going to be a tough nut to crack, 16.16. You can see it's just, it tried it once, it pushed back. It's going to try it again. If you're not in Ford and it can take out 16.16, then I think it's going to go higher, back up in this area up here. But I don't know if it's going to be able to penetrate 16.16, okay? But that's kind of where we're sitting there with Ford. So I'm not too sure about that one. Although near term, it's clearly they had good earnings. They're reporting a lot of people buying cars. I know Mercedes came out and said they sold the most cars in January and they've done in a long time. So people are spending. That's why discretionary, I think, may be an interesting. Just be careful though on the discretionary side. Let me just see here. Let me just what do we got here? Bear with me 1 minute, guys. I hate it when it does this. Okay, here we go. Let's see. Okay. Let me get it back up here on the screen here. Okay. You wanted to know about this one. Well, I hope you're short this guy. If you're playing a bounce, then that's probably all it's going to do. Again, looking at this one right here, it would suggest that, you know, this thing is going to come up and roll over. Although, you know, we've got a key pivot here at 20, right? and then we had this low down here at 8. So that's just a huge range. To me, this would be a day trading stock. It just took out its 50 EMA right here. You can see the 200 EMA way north of there. By the time it gets somewhere over here, the 200 EMA is going to be flat somewhere in this area right there. So I don't know. Take your pick on something like this. I would day trade it, but it's probably a higher risk stock. So that would be my just initial gut on that. Let's see here. I was watching a webinar presenter saying that using options market futures contract give a better protection against the future than technical analysis indicators because it's based on what a market is thinking of future. What people in the skin of the game are thinking. How will you go about doing that? Okay, let me see if I understand the question here. Futures contracts give a better projection about the future than technical analysis indicators. Wrong. Futures gives you an idea of what the price is today for the future. Technical indicators will give you the potential areas where both buyers and sellers are winning or losing because it's based on what the market is thinking of the future. Well, that's true. Futures do that. What people with skin in the game are saying. Okay, so basically what the guy was saying is the futures market gives you what the market is thinking today in the future. And that's like volatility. Implied volatility is what the market is thinking of volatility over the next 30 days if you're looking at the VIX compared to where it's been, historical volatility. But every day, Manu, it changes. Every day it changes. The futures market changes every day. And you've got to say, well, gee, is the odds favor a change to the upside or to the downside? You've got to use the charts. You've got to use indicators to say, well, buyers, who's in control, Manu? Who's in control? Buyers or sellers? You've got to know who's in control. And it's very difficult to do that. And in a futures market, the normal layout of most futures commodities is in a contango environment. Contango means the further out in time you go, the more expensive the futures contract becomes because you've got duration, which adds to the carrying cost of the contract or the commodity. Backwardation is when the front month is more expensive than the back month, and that's generally caused by fear, demand issues, or volatility. So there is a whole, I would go in and look at our futures webinar. It goes through a lot of this in detail. You cannot. It really pisses me off when someone goes, well, this is better than that. There is no one thing that's better than something else. You got to use everything together to be able to draw an analysis and a conclusion on where you think the markets may or may not go, right? Yes, it is a true fact that futures today, if you look at a future price of oil out in time, it says oil is going to go up in price, okay? But if you look at the indicators and the technical analysis, it'll say, okay, it looks like it's going to go up, but here's where you're going to encounter resistance, okay? This is where there can be expected to be resistance. And as you move closer in time, you can see if that comes true or not. One supports the other. One does not replace the other. So that knucklehead is a rat brain. And believe me, I know a bunch of rat brains over at Toss because I know the founder, great guy, really good guy, and he knows his stuff, but there are people over there that behind the desk that don't know what the crap they're talking about. But there are other really good guys over there as well, and I like them. Really good stuff, good product, great platform. But there are a few people there that just sometimes they put out information that sucks. All right, one other we're going to look at here, and then we're gonna wrap it up. So let's look at Facebook. Let's get on here. Take a look at Facebook here. Okay, here's Facebook. You can see right here that we've got a solid support point at 71.33. This is a tough one, Mark, because it's in a very tight range, longer term. So my question to you would be, are you trading this long term or short term? Long term, the odds favor a movement in that direction. Short term, it favors a movement in this direction, okay? And if it takes this out, then longer term, it can come down and test this guy down here at 55. So it depends on your time frame of the trade, and how you want to play it out. That would be the way I would read this. But I would watch 71.33 because we're heading probably down in that area. There's a little interim pivot right here just north of that around 72.50, 73 area. But outside of that, that would be the major stopping point I would look at there. Would I be interested in shorting it if we take that one out? Yes, I would. All right, everybody, I hope you enjoyed our session. We covered a lot. If you're not a member of our group, I highly encourage you to come on in and check us out. We got a lot of stuff going on. 2015 will be a lot of fun. For our members, we will not do a Sunday night session. This replaces that. I will see you guys Monday morning in our chat room. And then we got our Tuesday morning session. Have a really good one, everybody. Have a great weekend, and I will talk to you guys later. Bye-bye.